Welcome to Herb W. Morgan's Slaying Bulls and Bears, a podcast about economics, markets, investing, politics, and profit. Every Monday, in less than 20 minutes, Wall Street portfolio manager Herb W. Morgan distills the complex and complicated into the simple and sensical. Here's Herb now.
Good morning. It is Monday, June 3rd, 2024. I'm Herb Morgan, Senior Managing Director, Chief Investment Officer at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, you can follow me intra-week on both LinkedIn and on Twitter. This presentation has been prepared by us, Cantor Fitzgerald, for use with both financial advisors and investors. Of course, they're each expected to make their own investment decisions. Nothing in the presentation should be construed or treated as investment advice or tax advice or the recommendation for the purchase or sale of any securities. Investors are advised to consult their own tax advisor regarding any tax consequences of any contemplated trades. Views expressed herein are mine and mine alone. They may differ from the views of CFIA's parent company, affiliates, or other portfolio managers. Well, we had an interesting week. Equity markets were mixed. Look at the S&P down 0.5%. International markets, emerging markets especially down big. The ACWI actually down, should be in red. But look at small cap, had a nice bid. Why did that happen? Well, small cap is particularly sensitive to interest rates. And if it's perceived that interest rates are going higher, small cap does worse. If it's perceived that interest rates are going lower, small cap does better. So at least for the week, this seems to change every week, there was this perception that maybe the interest rate cuts are back on the table and closer than we thought. On the world of fixed income, kind of really unchanged, not much activity going on there. The longer dated rates went a little higher, steepening the curve down almost 1%. A couple of things I thought were interesting. Going back to my comment a second ago about small versus large cap stocks, I put together a graph and took the PE ratio or multiple of the S&P 500, subtracted the PE ratio of small cap stocks as measured by the S&P 600. The difference, 7.5. In other words, the S&P 500 multiple is 7.5 points higher than that of small cap. Another way of saying small cap stocks are cheap relative to large cap stocks are expensive relative to small. Does that mean anything? Well, for a long-term investor, it might cause you to want to get in there. But it also could tell you that if and when the rate cuts do come, given the valuation difference as well, you could end up with a sizable outperformance of small caps by large cap stocks. The challenge for any investor is figuring out when and how to play that at a time when large cap's doing so well because it's led by big cap technology, which is where all the earnings growth is coming from and therefore all the stock market performance. The other thing I noticed, and you've noticed, we have a position in China. We've started to include reporting on the China Shenzhen CSI 300 index in our weekly list of indices that we choose to put out for illustrative purposes. Take a look at the 5-year return. So it's normalized at zero. This is the S&P 500, the blue line here. You can see it's up 90% in 5 years. Meanwhile, Chinese stocks, 5-year total return of about 4%, a massive gap. And if you think about it, all that gap really started early 2021. They were kind of trending together, and there's been this separation, this gap. What happened? Massive crackdown on COVIDs. Extensive, lengthy crackdown on COVID, crackdown on the tech sector in China, on the corporate sector in China, a collapse of the housing sector in China, all of those things now priced into the market. We like China for patient long-term investors, and we've begun to see some performance, as you can see here, really starting in about February of this year. Last week's economic data, mixed. FHFA house price index was expected to go up 0.5%. It only up 0.1% in the month of March. Bad for your balance sheet, I guess. It only went up 0.1%. Good for those trying to get into the housing market for the first time. And of course, translated into inflationary pressures, things such as owner's equivalent rent. A little bit better news than what we've had recently. Also, the S&P Case-Shiller Home Price Index, just a competitor metric for those that follow the residential real estate market, up a third of a point in the month of March after a half a point in February. Year-over-year gains for both are in the high single digits. Also saw some data for pending home sales. Those are home sales that are under contract, not yet closed, in the month of April, so a month out from the other two, and it dropped significantly. That suggests that maybe those housing gains are moderating or perhaps even stopping or reversing, which would help on the inflationary front, of course. They say that pending home sales dropped almost 8%. The estimate was only for about a 1% drop. So that's pretty significant drop. Why? Well, partly prices, partly interest rates, partly inventory, all of those things combining for slow days in the residential real estate transaction market. The Conference Board put out their monthly report on consumer confidence. This was for the month of May. It actually rose. You can see it over here on the right. Nice little dip up. You can see that there from 97.5 to 102. That was above expectations of a decline to 96, which would have been a 1, 2, 3, 4, fourth consecutive month of decline. So it's the first increase in 4. And it was ahead of all estimates of the economists that report into the Bloomberg service. What's good about that? Well, it changed the trend, but we also saw that perceived recession of perceived likelihood of a recession coming increased. Household debt is on the rise, which is a signal that in the future spending could take a hit. And the job market, which is still robust and still ebullient, has slowed and softened somewhat, according to the respondents of this survey. Expectations rose a little bit. So, okay, mixed to good news there, I guess. The good news that keeps rolling, though, is the jobless market, the job initial claims for unemployment that comes out every Thursday morning, 5:30 a.m. Pacific time. We're in that low 200 range. We've been in that low 200 range for about 3 years now, and that is a sign of strong jobs growth and pretty low continuing claims for unemployment as well. We did get a revision downward in first quarter GDP growth. Now, second quarter GDP, which we're in the middle of generating, is still tracking, at least according to the Atlanta Fed GDP Now Index, is still tracking pretty high. But when the market saw this get revised from 1.6 down to 1.3, they said, aha, maybe the economy is not as strong, growth isn't as strong, maybe the Fed can cut rates, and that's what sort of gave that small cap lift. Remember I showed you at the beginning, the small cap lift last week? It was really correlated to this soft Q1 GDP print. Note that the GDP didn't grow 1.3% in the first quarter. It grew at an annualized rate that, if compounded over 4 quarters, would equal 1.3%. Personal consumption revised down kind of significantly from 2.5 to 2. Service spending, however, rose. Speaking of spending, personal income and spending for the month of April, really in line with expectations. Income rose 0.3%. Spending rose 0.2%, just a tad below the expectations. And then, of course, the biggest event of the week was the core PCE, personal consumption expenditure inflation reading. This is the measurement that the Fed uses to target their 2%, their self-imposed 2% target, to meet the government-imposed, the congressionally imposed mandate of price stability. And they defined it as core PCE year over year. That's the red line at 2%. Go all the way back here for a decade. You can see always well below. They would start to cut rates as it approached that. So they were kind of defensive. And you would think here, well, they wouldn't really start raising rates. And they wouldn't really start cutting rates till we really got approached or went through. And that's really where the debate lies right now. We're still above target. Why would you cut rates? Well, especially if you have full employment. And I think they probably won't. And every week, there's a little thing I follow called Fed Speak, and it tells you when everybody's speaking. And I get news alerts every time one of the voting members speak. And it kind of tells you what they're thinking, and they try to telegraph to the market what they're thinking. Of course, this week they can't speak at all because we're going into we have the meeting coming up on the 12th. But the 9th rather. All that being said, no reason to cut rates yet. No reason to cut rates yet. PCE was up 0.3, right along right in line with expectations. Core, the more important one, 0.2. That's nice. That's the first 0.2 we've had in a while. And the year over year is 2.8. But they really want to see that 2.8 down at 2.0 or below. The Chicago PMI, Chicago Business Barometer, really fell precipitously, significantly for the month of May. Fell from 37 to 35. The estimate was for 41.6, 6 straight months, actually it's more than that, monthly declines. New orders fell from 38 to 29, or 37.9, 28.7. Production was up a little bit. None of this is particularly great for the Chicago region. You can see, we had this recession here, right? This was the shutdown. This was the forced economic shutdown. So we are seeing signs of slowing, but we're not seeing it yet work its way into consumer prices. And that's the key for the Fed. They have to maintain that consumer price stability, which are really, frankly, having a hard time doing at this juncture. Okay, in terms of economic data, lots this week. The S&P final manufacturing and PMI, as well as the ISM final manufacturing PMI. We've got construction spending, auto sales, JOLTS or job openings, which have been steadily declining. You can see 8.5 down to 8.36. We had been at 12 a couple of years ago, so that is coming down. We've got the jobs reports from both ADP and the Bureau of Labor Statistics, as well as the unemployment report, unemployment rate, hourly earnings, et cetera. Lots of economic data this week. I can tell you that we got the manufacturing PMI already, and it did exceed the 50.9. I hope you find this useful. Don't forget to subscribe to the YouTube channel, Slaying Bulls and Bears. We make the complex and complicated simple and sensical. It's also available as an audio podcast at all the various audio podcast podcast formats. Past performance, I got ahead of myself, or targeted results are no guarantee of future results. Every investment may lose money. Okay, we know that. Thank you for tuning in. We'll be back to you again next week.
Thank you for listening to Slaying Bulls and Bears. If you'd like to download the slides for this week's podcast, go to www.efficient-portfolios.com and join our mailing list. Don't forget to subscribe to our YouTube channel, rate us online, and share with a friend if you found this helpful. See you next week.